Okay, I explained hedging, reverse auction. In a normal auction, this is what I'm talking about dynamic traders right now. In a normal auction, what do people do in a normal auction? In other words, if you're in a situation where things or items are up for bid, when you bid, when you're outbidding somebody, what are you doing? You're eliminating the competition, right? In other words, by bidding higher, you're hopefully eliminating anybody else who'll bid higher than you. Hedgers and commercials and dynamic traders create what I call a reverse auction. They'll bid a market up or offer it lower to try to attract the public into the market to take the other side of their trades. You guys with me on this? They will bid a market up or offer it lower as a reverse auction. That doesn't mean that they want the market can go higher, but their immediate objective is that if they're bidding it up, it means that they want to sell. They just want someone to take the other side of their trades. So they're actually creating a reverse auction, attracting people into the market, because as the market goes up, people are thinking, okay, I'm going to be missing out, and I've got the assurance that I need that it's going to keep on going, and so they get sucked into this move, and then they slam them with a huge order. Now, see, I had intimate contact with all of that at Merrill Lynch. I really, not only that, I mean, because I knew the floor traders, I knew many of the floor traders who actually created the movement that particular day. And there were a number of times where the movement was significant and they were fast markets and enough to attract the media to the exchange, and they put a microphone in front of their mouth, and they definitely would say something that was palatable to the public. In other words, what was reasonable. I can guarantee you that the reason why they did what they did during the day had nothing to do with what they said. Nothing. There was no relationship whatsoever. Go ahead.
I fully understand your concept of the movement that's taking place because of dynamic players. And I can understand how that would relate to the commodity, stock, and stock options market. But can you have the same effect in, say, the foreign currency market, where it's a much bigger market that's traded worldwide?
It just depends on the player. Absolutely. You get a central bank that starts unloading something, and then it's gonna have a major impact on the market. Yes. But you've got basically what you have is a situation where this market's so large, it's so liquid, that it would be very difficult for individuals to have any impact on it. Is that what you're saying to me? Is that what you're...
Well, I wasn't necessarily limiting it to individuals. I mean, even a central bank on the world market, could they have that kind of an impact?
Well, it's what I call the pebble in a pond effect, okay? They might not have enough impact initially, okay, to do something, okay, to have that meaningful, to create that meaningful of a price move. But you've got a pebble in a pond, which is the way a lot of prices move anyway, because it's like what you got is you drop a pebble in a pond. Well, if it's, it creates waves, does it not? Okay? And what I found is that, especially with floor traders, and really the same kind of dynamics work even with off the floor traders in the general market itself. I found that what you had is that most floor traders did not know what they were doing, in the sense that they didn't have a real good reason for buying or selling at any given moment, other than the fact that they were following the lead of other people who they thought did have an idea of what they're doing. So what ends up happening is that what you've got is the guy, the trader who's confident, knows exactly what he's doing, why he wants to do it, and does it. And then you got all the other guys who are, let's say, in the pit, okay, who are closest to this guy might be on this step right here, who are closest to this guy, that will mimic what he does. And then what it does is it starts spreading out. And that as word gets out, okay, the guys at the farthest end up getting prices that are greatly diminished in relationship to this particular individual. But the point is, it's kind of like the pebble in a pond. A central bank could create the same thing. In other words, initially, a central bank hitting the market with a huge order might be absorbed, but the fact that the central bank is doing it will cause other people to want to do it too, and therefore, as a result of all the other traders who pile on, it creates a huge move. Does that make sense? Okay, we're moving right along here. Okay, dynamic traders, okay, players, they know and understand the mindset and behavior patterns of the crowd or herd. They basically refer to the general public as the herd, and they are the herd masters. Okay, they are the herd masters. Whenever possible, they will use that knowledge to move prices in a way that will extract the most amount of money from the largest number of traders. That is their mission. That is what they do. Characteristics of passive technical traders, they're usually mystified by price movement. Would that be a fair characterization? Okay, they wouldn't think about trying to cause price movement. As a result, they typically can't conceive of anyone else doing it either. They're typically drawn into trades based on an opinion about the attractiveness of the price or stampeded out because of fear. The passive technical trader's objective is to find himself in a winning trade without any intent to move prices. Now think about what you're doing. You are trading in a way where you want to find yourself in a winning trade, but absolutely wouldn't even think about moving prices to do it. You're completely dependent on someone else doing it for you. To find himself in a winning trade, he's dependent on other traders to be willing to either buy or sell at a worse price than himself to create movement in his direction. The typical passive technical trader is expecting other dynamic traders to make him a winner when they usually have little or no knowledge, insight, or understanding about how dynamic traders operate. Would that be fair? The typical passive trader does not realize it only takes one dynamic trader somewhere in the world to negate the positive outcome of his edge. Is that a fair statement now? Does anybody want to argue with the statement anymore? And I'd say anybody did in the first place, but there are some people who raised their hand and said that that wasn't the case. Is there anybody that's not convinced about this? Seriously, I want to know. And we're not going to get into a fight or anything, but you know.